How's it going, everybody? Welcome back to another episode of Smart Money, Smarter Moves with our CIO, Kyle. For this episode of the podcast, we want to let you know that we just released Kyle's insights and forecast on AI. We've had a few client conversations recently about, is AI a bubble? Are valuations too high? And these conversations are stemming from seeing stocks like Nvidia trading over $200. Nvidia, as you know, Kyle, recently became is it $5 trillion company now, valuation. And before getting into what we're going to cover with the government shutdown and tariff, I want to go right into that. Nvidia 5 trillion. I know that's a stock you've been following. You know, you are an investor in Nvidia in client accounts. In full disclosure, we're not giving investment advice. What are your thoughts there? 5 trillion.
Yeah, I mean it is deserving. So first and foremost, I'll say it's deserving. There's still even tremendous possible upside, to Nvidia and its growth projections. However, as I said on this podcast, and like you said, what I've just kind of sent out to a lot of our clientele, sort of a write up on it, is ultimately things, it is still pricing in the potential growth. It's not there yet, right? So it's trading at a high multiple. It has all this potential. If we can open up the markets of China, et cetera, there's significantly upside. However, as we know, there's competitors out there, and it could move. Nvidia runs everything on creating the AI, and eventually some of the spend may move more to the inference side, and that could take away, some of the upside potential. So it's always just it's still there. Again, I don't think we're in a bubble. There's a lot more. There's going to be certain pockets, especially in the private markets and things like that, where you're going to see people lose a lot of money. But we're not in a bubble. There's still actual real value, real earnings. I still think we're sort of in the early innings of it, but diversify, because there's going to be definitely some winners and losers, and things could change tomorrow to have Nvidia sell off 20% if a competitor, or China comes out with a new product, et cetera. So just continue to diversify, but it still has legs.
I want to ask you about that real quick, Kyle, just because everyone tends to stay silent when they see the run that a company like Nvidia's had. But if on next week Nvidia drops to like 160 or 170, there'll be a lot of talk about it. Is it over? Is it this? You know, if someone today is starting to invest in Nvidia, should they worry about these cyclical moves downwards? Like if it goes to 150, 140, or would you consider those normal, healthy pullbacks?
On a name, I would say that, and for most stocks, that would be a pretty dramatic drop, and you'd have to think that there's some sort of, more systemic issue. On a company like Nvidia, where again it's trading at high multiples and it's pricing in some future optimism, where all of a sudden some sort of narrative quickly changes and it sells off. I would not be, you have to know, if you're buying it now at these levels, that that's a possibility, right? So you have to go into it with that sense of urgency, and then continue to if it sells off, do you still have belief that, is this an overall, the spending going to stop? And if not, which I don't think it is, it would just be a buying opportunity, and to kind of double down on your commitment and buy more. So you have to be able to stomach that. That could easily happen. It could just be sort of par for the course. Nvidia almost got down to $100, earlier this year, after the DeepSeek announcement from China came out. And like you said, we're over $200 a share now. So it's kind of par for the course for a company like Nvidia. You have to just you still want to watch it. You don't want to just buy and hold forever. You do want to continue to watch, because things could change. But right now, I think the story is intact. And if you got to sell off, you just be a buyer.
Good. That's actually really helpful to think about. But on the flip side of it, you mentioned you'd have to see some fundamental shifts to see a drop like that, unless the markets are just naturally dropping. But Chipotle, for example, just had earnings, and Chipotle had its worst day in over a decade. And when I look into it a little bit, Chipotle's down over 50% for the year. Seems like fundamentally still a good company, but it's had a dramatic turn. And I don't know if it's because they missed earnings, or they're saying Gen Zs and students aren't buying Chipotle as much. But what do you look at when you're in the seat on the flip side, a company like Chipotle that you think seemingly has good fundamentals, down over 50%?
Well, it's a little bit of the same thing where you're following a stock. Chipotle has been on a huge run for a long time. based on it has been able to continue to grow every single year, open new stores. The story just seemed intact and it starts to get priced out that, what's happened in the past is going to continue in the future. Obviously, every company is going to somewhat be impacted by macroeconomic factors, as well as their own saturation, in the market. So it's just kind of a story that for the past few quarters in a row, their same source sales have have dropped. So it was already trading at a significantly higher multiple than any other food, most any of its competitors were. So that just kind of came to 50% pullback is a dramatic sell off, but its valuations just kind of came back more into reality. And then again, one of those things where if it still is going to be, you still believe that there's, if you look at kind of its market presence and you still think there's more room for it to grow and expand, then you'd be a buyer when it's back to normal, normal levels, because then its trajectory can continue. So I think it's when you're following things, you have to sometimes take a little bit of the profits off the table. When you realize them, as much as you want to ride things out forever, things don't last forever. Take some of the profits off the table as you're going, because things can change in an instant. And like I said, in that particular Chipotle, yeah, the macro environment, as we've kind of talked about, we're in a sort of a K-shaped economy where the higher end consumer is, and AI capex, and the higher end consumer is basically running the entire economy, whereas the lower end consumers struggling a little bit. And so if they're buttoning down and not eating out as much, it could hurt, a company like Chipotle. So you have to kind of just be thoughtful with your portfolio and on where you're at and what valuations you're willing to pay. Like I said, if you compare just the valuations, though, a company like an AI versus a Chipotle should never anywhere be anywhere close, right? You still have to accept a higher PE for an AI trade because of the future benefits, knowing again at some point there could be a bubble, and you could get hurt. So don't just throw money at it without any care in the world. Definitely follow it. But like I said, the difference is I think the AI trade is still has plenty of room to go.
Yeah. And real quick for Chipotle, are you a buyer here?
Yeah. Yeah. I mean, again, I don't I haven't been picking it up in most of my clients' accounts, not because I don't think I think now it's a decent valuation. I think the growth stories there. I personally am a big fan of, you know, Chipotle eating there. So I think that
Uh,
yeah, it will continue its growing ways at some point, especially when the macro environment sort of calms down and we start to like going into next year. Let's say a lot of lower end consumers might get tax refunds. They pick up their spending right back again and at Chipotle, right? And they have a great year next year. So I would be a buyer. I'm more focused still on some things that have some higher growth, but I think it's a decent valuation. It's a good longer term play of Chipotle at these levels.
Thanks. Yeah, that makes sense. I mean, it's such a staple brand that sometimes, despite seeing valuations crush, you have to also get realistic and say, "Hey, do I still go there? Is the business still intact?" So, always great insights from you. What
And
about?
is there room for for them to raise prices? There is. I think compared to um, like I said, the lower end consumers pinched a little bit. So they are just, it's not like they're swapping out Chipotle for other places. They're just eating at home a little bit more.
Yeah,
Once they go back to their regular eating, is there room that Chipotle will be one of their main places? It probably will be. And then will they be able to then start to increase prices over the next 5 years? And likely, as long as they continue to have the consumer base and able to raise prices, right, earnings should be able to continue to grow and, over the next 5 years or so.
right. Yeah. And how about everything going on with the government shutdown? When I last spoke to you, we were still shut down. Looks like we're still shut down.
Yeah, so we're about 31 days, right? Since we started the shutdown, coming very close to the all-time, record of a 35-day during Trump's first uh, term. You know, it's still hard to say when it's going to potentially end. Just today, Trump, tweeted that let's do the nuclear option of getting rid of the filibuster, which is basically right now it's a 60, this in the Senate, you need a 60 vote majority. If they got rid of that and it just became the overall majority, obviously we could we could prevent some of these government shutdowns in the future. However, I don't think that's the right option. I don't think anyone's willing to go with that. There right now, it is certainly hurting GDP, slightly every week that it's shut down. It's taking 0.1, 0.2% off of GDP for the current quarter. Usually that's made up once it's reopened. Right now, some things that could hopefully by next week we get a deal is food stamps are about to run out November 1st. So, there's going to be a lot more pressure on politicians to get something done if, a huge 40 million plus people in the US that rely on food stamps aren't getting their food and the money they need. So, hopefully we can get something moved there. As you see, the markets continue to do well, though, even in spite of it. The main thing is just us not getting economic data timely. So, fortunately, we're probably going to get the CPI data late, or probably not even at all for October. The job data will probably get late. So it's not good that we want this data to help determine how the economy's handling things. But hopefully we get it resolved and get the government opened here next week.
Yeah, I guess next week we'll on the podcast we'll find out where we're at. The last thing I want to ask you about, because we try to keep these podcasts short, specifically for the entrepreneur in mind. The Fed had the meeting this week. I saw Powell speak. I watched the Nasdaq go up, go down, in typical volatility fashion with the Fed. But give us just the raw, uncut. What are your thoughts on Powell's comments? What does that mean for investors? Can you simplify it for us?
Yeah, so the Fed did go ahead and cut again the second time this year, bringing the Fed funds rate to 3.75 to 4%. So it's a 25 basis point cut. That was pretty much priced in and fully expected by the markets. One thing that wasn't necessarily fully. It was a little bit different, which Powell mentioned was going to happen, but they moved it up the timeline a little bit. Was they did end quantitative tightening, which ultimately is the Fed owns bonds on their balance sheet, and they've been letting those run off, so they're not reinvesting back into the bonds and letting a certain amount run off every month because their balance sheet swole up from quantitative easing back in 2020. So they stopped that. So now basically they're maintaining their balance sheet where it's at, which just provides a little extra demand to treasuries at this point in time. The 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 main takeaway is the market sold off a little bit on the announcement of the cut because the markets were pricing in also a cut in December. And they were pricing in a cut for December and two more next year. Well, during the press conference, Powell mentioned that a December cut is not a foregone conclusion, and he said far from it. Actually, we had one dissent saying the dissent meaning all the Fed members vote on what they think rates should do, and they usually come to agreement on let's cut 25 basis points. This time we had two dissenters, one saying they wanted a 50 basis point cut, and another one saying that they didn't want any cuts. So Powell reiterated that there's a huge discrepancy on the members' views on the risks out there of inflation and employment. So he's saying that's not a foregone conclusion. So 10-year rates moved from a little bit below 4% up to about 4.1. So I think we're still likely to get a December cut, but it just reiterated that they are data dependent and they want to look at there's definitely arguments to be made on inflation. We just got CPI data last week, which came in a little better than expected. It still showed that core inflation went up about 3% over the year, but that was better than the 3.1% expected, right? And just to remember, 2% is the Fed's goal, so we're still way above that. But at the same time, employment numbers haven't come in a little lower, so they're trying to balance that. So it is just data dependent, um, and it's just to kind of say that the economy's still been growing, even with rates where it's been at over 4%. Rate cuts are good and stimulative. It may not have as much impact on the employment figures as we'd like, but I think at the end of the day, we'll likely still get more cuts at the end of the year.
Thanks, Kyle. You always give us the insights that we need without having to listen to Powell speak for hours. So appreciate it there. If you guys are looking for a new money manager or looking help to manage your money and you have, typically we require at least 5 million, but towards the end of the year, we have looked at accounts between 1 to 3 million. Kyle does offer a free analysis for you to look at if you're looking to move over money or talk to a new advisor. So if you want to reach out, go to freedomfamilyoffice.com or email me at samir@freedomfamilyoffice.com. We'd love to talk to you. And if you like what you hear on the podcast, subscribe on Spotify, Apple, and YouTube. We'll be launching a landing page, a new book for Kyle, and some additional updates for Freedom Family Office. But make sure to download Kyle's insights that he put out in the AI bubble just yesterday. Thanks again, Kyle. We'll see you guys soon.
Thank you guys.